Guys, welcome to another edition of the Trade Genius podcast. Got my good friend Bob Kudla here. And guys, this podcast may be the most important podcast we've done since we've started podcasting. Are we at the market top? New year, new administration. We got a pattern to show you guys. You're not going to want to miss this. Let's get into it.
Trade Genius.
Bob, I wasn't joking. I think this is one of the more important podcasts that we're going to do because I think we're at an important junction in the road here, fork in the road, however you want to call it. We've been warning about a recession. We're always accused of being so bearish. I think I got lost on people that we said we were probably going to pump into the end of 2024. So far, everything that we, once we kind of aligned with that outlook, everything's happened. So now you and I have been wrestling with, is the high in? Is the high not in? So let's talk about it. Where do you think we're going from here?
Yeah, and look, let's do a little history lesson here. So our view has always been that there is a top coming with the inauguration. There's a low coming at the end of Q1. There's a high coming by the end of Q2. And then there's going to be a general market, I hate the word collapse, but general market sell-off going into the end of the year. And so what's been interesting to me is things are like, it could shift either way like a month, okay? And, I think Trump being elected kind of pulled a lot of the Santa rally forward into November, and then that sold back. And now we have a fractal that's kind of lining up with, hey, now we're going to get the Trump bump at the end of January. The quant guys are saying that we could probably maintain this market lift into the OPEX of February, which is basically a month and a couple days from now, but not get a new high. And you and I are both of the I think conviction now, high confidence that the highs are in, and we're looking at a 7-8, retrace as probably the highest we'll get on that, and then we roll over pretty hard. And so I want to throw this fractal up. This came from one of our subscribers. It dovetails really well into what we've been saying. So I like to show the visual because I think we generally agree with this. Now, fractals are just fractals. These are probabilities, but it's at the point now where it's showing that bump we're talking about. Now, will that bump be 2 weeks or 4 weeks? It doesn't matter. Mox nix. It's just that you'll see the rollover when it happens. And then you see, here, I'm pointing to the screen like you can see me pointing. Then you see that little slide that comes down. That's the February-March slide. And then we get a counter trend rally into June, which is interesting to this fractal. It's saying that it'll break basically the highs that we had previously. I don't think we're going to make an all-time high. So I think this fractal might be a little bit more muted than that. And then we get that swoon into summer, a lift into September, and then we dump into the rest of the year into 2026. I generally agree with this approach, Phil.
Yep, I would too. I think, where the line kind of turns into the gray lines there, that's, essentially where we're at. And this was actually done before the pump from the soft inflation numbers. So we've made a huge move back up toward that, what they're calling the 6,000 level. I actually think, though, on the ES, this is the ES chart, this is the futures of the SPX, I actually think it's going to be somewhere between 60.41 and 61.04. Okay, we're trading at 59.90 right now. So, I mean, big scheme of things, you're pretty much getting there, right? But could we go up? And why I'm talking about those levels, I'll switch over to the live chart here. Okay, so I agree with all of this. I think this is how it plays out. It's kind of like what you call the long kiss goodbye. People are so used to flash crashes in this market, but what the problem is, a ton of the younger market participants have not seen when the business cycle rolls over. And so really, like the great financial crisis was like the last time we saw that. And so this is how it typically goes. It starts to make lower highs and lower lows over time. Then by the time you're down in February, where it's at 4,900 over there in 2026, you're going like, oh my gosh, we're screwed, right? You should have been getting out at the May high. You should have been getting out at the November high, but you're not thinking that this market's in a bear market, right? But the bear market technically began all the way back at 61.50. So the key thing is, when you think you're in a bear market, is to start looking for validation of that. And that comes simply with lower highs and lower lows on the weekly time frame, right? That is simple as that. All right. So where are we at now? So we had this is a weekly chart. I can get this a little more granular down to the daily. This is our CPI pump, okay? And the 618 is 60.41, okay? We didn't quite get there yet, but I think that going into tomorrow, there's a higher likelihood that we do. And then on Monday, markets are closed, but Tuesday, you might gap up after the inauguration and print this 786 up at 61.04. Now, we get that. we got to watch, right? If we clear this significantly and we push up hard into this, then maybe we're going to get one last move up that could take us into the FOMC announcement, right? That's going to be the next big thing after the inauguration at the end of the month. So to me, Bob, it's like if we go up to the 786, right? We can even look at the SPX because that way you can like see the numbers that's always printed on the headlines, right? So pull that fib real quick. There you go. 60-30. Okay. So if we go up to 60-30 and we die there, then you know that should be massive red flags for you. If we blow through that, if let's say we close the day on Tuesday at 786 and then Wednesday we gap higher, I think that's a gap and go. We go for new all-time highs and that can run us into the end of the month. Again, we're only talking like a few days here of separation. So could that run into February a little bit in that scenario? It's possible. I'm not going to discount that. But again, this is the window of time, January, February, in my opinion, you start getting defensive. So don't sweat getting the last drops of blood out of this thing, just start getting out, right? Start legging out. It doesn't have to be binary. You don't have to like get out here. You could start leg out, leg out, leg out, leg out, and start transitioning to a more defensive stance. At that point, if we do get a new all-time high, that does extend things out because then you're going to have to get another rotation back down and then you're going to have to get another test higher. So that might add a few more weeks to this whole balancing act up here. Otherwise, we get that 786 and it rejects this area, the 60-30, then we're going to die off. And I think then we go back to this scenario long term where we come down into March, then we bounce up into May. And I think I'm not even that bullish for the bounce up into May, to be honest with you. I think the job numbers are going to start getting worse and worse and worse. And then we go down to August, typically October. I think that August move down to 5,100. I would actually shift that over into October, November. And then you get a bounce up into then I think you actually could see a Santa rally that we didn't get this time around, which then creates just another major lower high into January and then it dies off. So my time frames on that might not quite agree, but the structure, I think I do agree with.
Yeah, I mean, I totally get it. You remember, so right now we're getting Q1 results. They're generally okay. And
right.
in preparation for the Q2 results, that's where March is usually a really bad month, so
right.
Last year wasn't so much because I think the election, but this year, I don't think they can avoid it. And
that's a month too, Bob, where you have credit events typically for whatever reason. The way the business cycle works, you have credit events in March. Look at what, remember Silicon Valley Bank, right? That's when the Fed had to press the gas pedal again, right? And bail them out real quick. And that created a tailwind for the markets. That was in March.
Yep.
.com bust. Market peaked out in March. So
yeah, so guys, as a general rule, February into the end of March is treacherous times for the markets anyway.
Mm-hmm.
I think this year it'll be even more so. April into June tends to be a good period of time for the markets. Now, could it be muted? How we want to say it, with earnings and job situation, but it's generally a rising market. And then summertime, it's kind of weird. Summertime can either be flat fill, where you get that nasty August vacation dump that they spring on you some years, and then I think fall's gonna be pretty tough. So, but we're just gonna play it by ear. It's funny, we were talking before we got on about Fibonacci's and ranges and stuff like that. We have an indicator and an algorithm that lets you look at buy dips, sell rips, and it has the retracement levels baked in dynamically. And so you can see when you're pressing into a zone of resistance, and you can look for failures there, or you can see where you're pressing down into zones of support where you can look for reversals higher. So, like Phil said, we don't have to call the turn. We have to generally be on the right island, and I think we're going to be fine. And I think this time, Phil, the market will be synchronous again. I think a lot of things are going to go down with this first move. So I think it behooves people to be cautious. And like all I've been doing is building my hedge positions, ever since the election, a little bit more bearish as we go, and then just take advantage episodically for these moves like we had yesterday in the market. So final thought, Phil, I'll say is that today we expected this consolidation. It invariably happens after a big move, especially if it's on a Thursday consolidation. But Friday into a 3-day weekend, I'm generally looking for a pretty aggressive market move higher. And then you have a thought on Fridays, Phil. Why don't you share your insight on what usually happens on Fridays?
So on Fridays with these markets lately, what you tend to get is that if you look at it on a weekly chart, for example, so here we are on Thursday. If Thursday, your weekly candle is looking like this, more than likely you're going to make the high for the week on the Friday. And the same is when you're in a down week. This was what happened last week, right? Big red candle going into Thursday. This low, this wick occurred on the Friday. So whenever you're at the upper end of the weekly candle, most likely they're going to carry that move through and put a high in on Friday. Now, it's not to say that you can't make a low or a high and then reverse hard on Friday the other way, but you just know that you're probably going to see another high or another low into that new Friday candle, and probably carries through into the cash open in the morning. So, and then if they're going to reverse it, it'll be sometime after probably the European close, 11:30 a.m. Eastern. But that's what Bob is referring to, is this phenomenon that as you get, if you're holding toward the highs. So tomorrow we would be looking for a new high over the current market. This is the SPX. So if it carries, we'll see a new high over 59.64 basically into tomorrow. Maybe we'll gap up tomorrow. So that's something to keep an eye on.
Yeah. Market rarely sells off going into a 3-day weekend unless we've really been struggling. Don't short this market today. All right, guys, thank you. Come check us out, tradelikeagenius.com, and get our packages, trade stocks, trade crypto, trade futures, trade options with us. So with that, I'll let you guys go. Phil, thank you so much, and we'll try to sneak another video in tomorrow here and call it a week. Thanks a lot.
Take care.
Trade Genius.